Good evening, everybody. So tonight we're going to talk about volatility and dealing in increased market volatility. So what do we mean by volatility? Can we measure it? Well, volatility is simply when markets are expected to move quicker, faster, not necessarily in a straight line, can get a lot choppier. And, can we measure it? Well, I think as traders, we'll get a gut feel that things are beginning to loosen up a bit and you're getting more unexpected moves. But we do have a VIX, a fear index, as they say. It's linked to the S&P, but I feel, whenever we see this starting to move higher, indicating that, volatility may be coming upon us, we can actually relate that to other financial markets as well. So we can see here, if we're below 20, we've got calm and comfortable markets. Maybe there's not too many drivers. Maybe it's seasonal. Anything like that can influence it. But as we see, the chart on the right-hand side of this starts moving up towards 28.3 on 22nd of April. And, the benchmark up there above 30 is where fear really comes into the marketplace. We have uncertainty and doubt. And it's at those levels we probably can expect 2 to 3% moves in stocks daily. That's not necessarily 2 to 3% in one direction. It could be a very choppy market where we see those type of moves up and down within that day. So markets clearly getting trickier. We can look at that and think, great, more opportunity for me. If a market moves 2-3%, I can capture that and it'd be great for my bottom line. And that's very, very true. But we should also be prepared that we need to be trading slightly differently because when markets do start moving away from us, we've got tougher decisions to make, particularly if we're intraday traders where we have what I call in-flight decision making to do. Our order management needs to be a bit sharper. Our disciplines need to be good because these things, when they move, as volatility gets higher, are going to move faster and can reverse a lot quicker. What do we see here? The direct correlation between the fear index, the VIX. As we see that sharp move up on the left-hand side in the VIX, we can relate that to the move to the downside, very, very violent, 5.8% down in the stock market there, the USA 500. That relates to that move up in the fear index. And all good gains on the left-hand side have been wiped out very quickly. Lots of sharp red candles, long red candles, straight line trading. Nobody likes straight line red trading. If you can imagine yourself being long in these markets, you're going to get taken out pretty quickly, or you're going to be forced to make some bad decisions if you stop yourself out as the market begins to really, really fall. So what can we do to help ourselves? We need to start understanding our markets. Are there any other indicators that we can look at? Well, clearly Bollinger Bands, as we know, as they start widening, is generally a good indication of volatility. One thing we can do with that fear index, the VIX, it's related to stock markets. They're generally long-only traders that are in those markets, so we generally can relay that to a potential collapse in the market or certainly a fast reversal. In other financial markets, please be aware, it can just mean very, very choppy behavior, and it's not necessarily directly linked to one-way traffic. So we can start getting indicators from the Bollinger Bands as well. And that should start our mindset changing, thinking, okay, I'm moving to difficult times here. What should I be doing now? Well, clearly we should be understanding that environment. We should be looking at all the influences that are coming into the marketplace. This is a great example here. We've got different influences, and that's probably why the volatility is coming into the marketplace. As we start moving up in the green zone, we've seen positive earnings from US Bank, from Tesla, and there's hopes there that China's central bank may cut interest rates. That'll be good for the global economy. Hopefully it'll open up some of these supply chain issues if that were to be the case and they were to lower rates and promote some growth coming out of China. But as we move to higher levels, we start seeing selling pressure coming from potential aggressive Fed rate hikes. We know the Ukraine war is a bit of a downward pressure on global growth. And the big outlier that came there was Netflix earnings worse than expected. Great example there that just because all the other earnings were positive, they're not all going to fall into line. And, you know, another example why the volatility is into the market, because there was change there. One thing I've put, be mindful of market positioning. Where generally market players are long, they've got a nice little upward trend there, and then bang, some strong comments from Powell, front-loading the Fed rate hikes, the Netflix surprise, and all you see is a bit of a collapse of the market, all those market gains gone, as we spoke about. And clearly market positioning was long, and that will basically mean on the turn, people chase to get out of this market, and it gets harder and harder to sell. So be very, very mindful of market positioning. What also should we be doing? We should be looking forward. All markets look forward. And what we see here for the next week is a plethora of more US earnings. Are they going to fall into line with Tesla or US Bank? Or are there some more outliers like Netflix? Who knows? That's why we have volatility into the market. The key message here is don't get tripped up by having a position and not realizing that these are coming out. Make sure you know when they're coming out. These do come out of hours as well, some of these, so be careful of that as well. And then relentless markets, again, while we've got more volatility, what's going to happen after we see an inflation number there on a Friday, and how will that impact going into the market close at the end of the week? Dangerous times, but as long as we plan and we know what's coming ahead, we can deal with it. So how do we navigate it? Well, what we do, we continue to look at our charts so we know where all the levels are, all the good levels, the historic data, the support and resistance lines. We can start gauging our target areas and, more importantly, where we want protection. Generally, in markets where there's volatility, we need that protection a little bit further away to give ourselves a chance to stay in it. What will that do? That will basically mean it's a bit more expensive if we get taken out on these stop losses. What I would suggest there is we start reassessing the amount of risk we put in the marketplace, so that if we did get stopped out on these further away stops, it's not quite so expensive. We still have risk in the marketplace. The market is going to give us more opportunity to make money because the moves are further or bigger. So we shouldn't be frightened to reduce our risk, because our stop losses are generally going to be a little bit further away. We can actually also look at other areas, you know, to really enhance our understandings of where these levels should be. And, you know, I've just added in Bollinger's there. There's many, many other indicators. Fibonacci's can give us some good levels in terms of retracement or target levels. Use all this information to your benefit to make yourself as prepared as you can. On the risk front, it is a change of mindset. It's not a weakness to reduce the amount of risk you put into markets in a volatile market. It's being smart. It's keeping yourself in the game. We need to be flexible in our trading approach, because as we've seen, outliers like the Netflix number can turn these on a sixpence. So we need to be very, very careful. But let's think about the confidence factor, the risk that we put into the marketplace. And as you see on the left-hand side, you really should be shrinking some of the risk that you put into the marketplace. If I can give you any tips, and we can come up in later webinars with some trading strategy and some helps around that whole trading, the little mantra there, markets are going to be tough, emotions are going to be elevated. Please learn to breathe. When things start going slightly wrong, you need to stay as calm as you can. People forget to breathe in those circumstances and they get a bit panicky. So sit back, breathe, constantly reassess the risk that you have in the marketplace, whether you should have it, whether it's too big, has anything changed? And once you've done that reassessment, that's when you get into that execution mode. The execution being either getting into a trade, out of a trade, moving your stop losses, whatever you need to do to survive in this market, to stay in your position and hopefully glean the big rewards that volatility can bring to you. Hopefully that helps, and I'll see you on another webinar.